credit card is a payment card given out by a bank that lets the cardholder borrow money, usually up to a certain limit, so they can buy things or get cash. The cardholder must then pay back the money they borrowed, plus interest and other fees at a later date. Credit cards can be an important tool for building credit and managing finances, but they can also lead to debt if not used responsibly. A credit limit, a minimum monthly payment, and an annual percentage rate or APR on balances are all common features of credit cards. The pros of owning a credit card include the following: convenience for making purchases, building credit history, earning rewards and cashback, purchase protection and extended warranties, access to emergency funds. The cons of owning a credit card include the following: high interest rates if not paid on time, temptation to overspend, potential for debt, annual fees for some cards. There is a risk of identity theft or fraud if the card is stolen or lost. Yes, this type of discussion can be boring, but if you are using your credit card, you need to understand the basics. Do not rely on credit card companies because they are not going to give you a lot of information that makes sense. We'll go over the 4 options you need to have when making a credit card payment. The next time you pay off a credit card debt, you can plan a bit better based on the different payment options. Every single time you pay off your credit card, you will be given the option to pay a minimum installment for your statement balance. In this video, we are going to go over each of the options, including the minimum installment, and hopefully everything will make sense with what they all mean in the end. First option, minimum payment. We will start with the minimum payment because this is also the easiest to pay, but will also work out to be the most expensive. For the minimum payment, you will only be paying about 1 to 3% of your total balance, but this will also include interest. This will mean it can take you years or more than a decade to pay off your current balance. If you keep only paying the minimum balance, even though you may only owe them $2,000, and the minimum payment is around $30, you would be paying a 25% interest rate and only $5 toward your principal balance. Every time you make that minimum payment, it could take a long time to pay off that balance because you are paying way too much interest compared to your actual balance. So you need to avoid paying just a minimum payment unless it is absolutely necessary. Setting up a minimum payment can be a great way to raise your tolerance for late payments without hurting your credit score. That minimum payment will end up costing an arm and a leg. While $30 per month sounds very affordable, it's a very expensive way to pay for something. Try to pay your credit card off as much as possible. So what are your other options? We'll move on to the next best option. Second option, pay off any amount. Pay an amount off your credit card, and it can be any amount above the minimum payment. Most people use this strategy all the time, and what you can do is select any amount you want to pay towards your credit card. If your statement balance is $1,000 and it is due in 20 days, you can simply pay $100 as the any amount option. The main point of this option is that you are not restricted to making one payment per month. You can make as many payments as you like, depending on what you want and can afford. You are never going to be restricted to paying a certain amount towards your credit card. It will be a lot easier to use this strategy with the help of online banking or payment options, or you can call your credit card company. You don't want to just rely on your monthly invoice or statement to come in the mail. To pay more often than once a month, you will need to use the internet or phone banking option for this strategy to work. Third option, Statement balance. This option entails paying for everything that happens during your billing cycle, which is usually about a month's worth of spending. Whatever you spend on your credit card and any interest will end up on your statement balance. The statement balance is the most important part, and you need to pay attention to it. As long as you pay off your statement balance by the due date, you will not be accruing any interest, which is a good thing. To not accrue any interest, you need to pay off that statement balance in full every month by the due date. Just be aware that you have to pay it off in full, and if you owe $1,000 on your statement balance and you pay $999 by the due date, then that $1 that you left is going to open up an opportunity for interest. The only way to get rid of interest is to pay the statement balance in full by the due date, usually a couple of months in a row. These are the rules of a credit card, and if you technically want your credit card to be free to use, just make sure to pay the statement balance in full. That is the main option that you need to pay attention to in order to have an interest-free credit card. This is the smart and recommended way to harness the power of a credit card, where you pay no interest and get the benefit of using a credit card. You need to make sure you continue paying the statement balance to ensure you aren't being charged interest. Fourth option, total balance. This last option is where you pay your statement balance and any new purchases that are not pending anymore. For instance, if your statement balance ended 2 weeks ago and you have made a lot of purchases since then, all of those purchases will also be added. You do not have to pay the entire outstanding balance in order for the credit card companies to not charge you interest. You just have to pay off your statement balance. If you want to, go ahead and pay off your outstanding balance, especially if you have the money to do it. It will allow you to stay more on top of your spending as far as credit cards go. Automated. Credit card companies allow automatic payments for your credit card payments. You can opt to pay either your minimum balance, the statement balance, or a fixed amount every month. This will come directly from your bank account, so you will need to make sure you have enough money in your account. By automatically paying every month, you will be unlikely to incur any unexpected interest on your credit card. If you are interested in learning more about credit cards, like how minimum payments work or how interest is charged, go ahead and follow Legend Finance for more exclusive content on personal finance. We will link all of our videos so you can learn more. Thank you so much for watching.